Good morning, everyone. You are watching a live daily market outlook from Windsor Brokers for Friday, 21st of December 2012. Basically, no significant action in the market. We are still at approximately the same levels where we were yesterday morning, with more pressure seen on the currencies opposite the US dollar. As dollar got boosted yesterday on the report after a U.S. Republican plan aimed at avoiding a fiscal crunch failed to gain enough support. So-called Plan B of Mr. Banner has been rejected by the opposite side, and the Republican lawmakers delivered a rebuke to their leader, as House of Representatives spoke John Banner, when they failed to back an effort designed to extract concessions from President Barack Obama in the fiscal cliff talks. The latest twist threw into disarray attempts to head off $600 billion of indiscriminate tax hikes and the spending cuts that could push the U.S. economy into recession next year. The renewed jitters over the fiscal cliff dented risky assets and gave lift to the safe haven dollar. On the opposite side, the gold hit fresh lows at approximately 16.35 on the sharp fall yesterday, while crude oil benefited, though still holding below the resistance, Fibonacci resistance at 90.42. Euro is holding its 2 days range floor at 131.80 zone. Though the near-term structure seems to be aligned more towards the downside, with the double doji on the daily chart giving more risk towards the downside and possible further reversal, as yesterday's repeated attempt at 133 failed again at 132.94. Sterling is also slightly under pressure, as 163 proves to be a tough resistance, but currently the price is congested between 162.40 is our initial support, and the previous peak at 163 and strong resistance at 163 zone. Dollar yen is also at the back foot following a failure to regain, to clear basically our barrier at 84.50. 84.61 was seen 2 days ago, but failure to sustain gains triggered a fresh reversal down. That's so far being contained at 83.80. This is initial support. Holding above this level still keeps hopes for a possible further extension higher. The dollar Swiss is in the corrective consolidative mode, the upside again, like other instruments, being capped at initial resistance at 91.50. Although the hourly structure is still positive, lack of momentum seen on the larger time frames is still keeping the downside pressure. We need to see break above 92, 92.40 in order to improve the current structure and allow for some stronger corrective action. From commodities, we mentioned already, crude oil reached fresh high at 90.52, dented its previous double top at 90.31 and the 90.42 Fibonacci 38.2% retracement, but a failure to sustain gains resulted in the dip down to below 89, 88.93 seen so far, with the still positive tone seeing the upside more favored. And gold, as we predicted in yesterday's analysis for commodities, when I mentioned that gold could travel as low as 16.30, we missed it for 5 ticks. 16.35 was the lows hit yesterday on the twice, with the brief consolidation seen preceding fresh weakness, most likely as a negative tone continues to dominate on the lower and larger time frames. Of course, some corrective action could be seen on the extremely oversold conditions on 1 and 4 hour charts. From the calendar, important things that have already been released come from UK and Germany. Consumer confidence, consumer morale basically is hitting its lowest levels. GfK consumer confidence for December from UK shows disappointing -29. This is the release for today, compared to a -25 forecast and a -22 seen in the month of November, with a similar situation in in Germany, though 5.6 is today's release. Again, disappointing from forecast at 5.9, and the 5.9 is also the December's release, seeing that slowdown in economies is hitting even the biggest economies in the Eurozone. From the other releases, important to mention today, it's the quarterly bulletin of Swiss National Bank due at 8:30 for the fourth quarter, and then GDP and the public sector net borrowing from UK are the highlights from the European session. The indicators are due at 9:30 GMT. Third quarter GDP is forecasted to stay unchanged at 1%, while public sector net borrowing for November is expected to jump to 14.8 billion sterling compared to 6.5 billion in the month of October. Significant increase in case, of course, the release comes along or close to the forecast, and also current account from UK is expected to show the narrowing of the gap to 13.1 billion sterling pound compared to 20.8 billion pounds gap in the second quarter. And then a bunch of data from United States and Canada at 13:30 GMT. Durable goods orders for November due at 13:30, as we said, 0.9% is forecast compared to 0.5% in the month of October. Core durable goods orders are forecast at -0.1% compared to 1.8% in the month of October. U.S. personal income for November, 0.4% increase from 0% in October, and the personal spending 0.5% up from -0.2% in the month of October. From Canada, GDP for October monthly release is forecasted at 0.1% compared to 0% in the month of September. Inflation in Canada for November is expected to go down by 0.1% compared to increase by 0.2% in the October. And the core CPI for November is forecasted at 0.1% compared to 0.3% in the October. And finally, University of Michigan consumer sentiment from US due at 14:55 GMT is forecasted to tick higher, 75.2 compared to 74.5 in the month of November. And it seems that according to the forecast, the consumer morale is going to increase in the United States compared to the decreasing one in the UK and the Germany that we mentioned previously. And finally, we're going to take a look at the technicals and see the latest movements and expectations for the major currencies as we are approaching Christmas holidays. Of course, some lower volumes could be expected, especially after the holidays, the Boxing Day, when the half of the markets will be closed. However, it's still active markets due to the coming and basically contradicting news are still moving in a way directionless in past couple of sessions. As we can see on the Euros chart, hourly chart shows that the pair pulls back of 133 resistance following a jump to 133.07 2 days ago, and yesterday's repeated the attempt failing at 132.94, offering good barrier at this point. However, the dips have so far been contained at our initial support at 131.80. This is the previous high, with the near-term studies still being aligned towards the downside, as hourly indicators are in the negative territory, and the 4-hour chart ones are descending off the overbought territory, with notion being additionally boosted by double doji. We had a gravestone doji 2 days ago, and yesterday's doji showing a indecision among the investors and the possibility of a stronger reversal as 133.00 so far offers good resistance. In case of loss of 131.80, that is our initial support. The next good one is at 131.40. These are the lows of 17th of December, as well as 38.50 0.2% retracement of the uplift from 128.76 to 130.07, reinforced by ascending a 55 days exponential moving average, and basically break below this level, and close to this is 131.25, previous high of 5th of December, would be a signal for some stronger corrective action, and signaling also the double top at 130.07, 129, pardon, 132.94, 133.00, and 132.94, and that would be again a bearish signal for some stronger reversal. That might open next support zone at 131.00 as a psychological support, and close to 50% retracement of the entire rally. Conversely, a regain of initial barrier at 132.51, that is yesterday's intraday high, would avert immediate downside risk and probably shift focus higher for a repeated attempt at 133.00. Break of 133.00, I would say at this point, is required to allow for some stronger recovery, above which we have immediate barrier at 133.69, 90 days weekly moving average, and 133.80 is the high of April 2012, seen as the immediate upside. The targets with the daily structure being positively aligned. We can see it. Still, there is still room for a possible further stretch higher as the rally of 126.60 low of 13th of November so far remains unobstructed, and the current pullback could be described as corrective so far. The British pound also holds below important and strong 163 barrier following yesterday's renewed attempt and failure at 162.95. However, downside is still protected at 162.40 zone. This is the initial support, and that marks near 23.6% retracement of the uplift from 160.84 to 163.05. A further extension higher, pardon, further extension lower could basically, this is approximately it's we put the wrong Fibonacci levels. I do apologize. We're going to change it. It's from 160.00 to 163.05, and it's approximately, it's exactly 23.6% retracement, with the next good support seen at 162.00 round figure, and the 161.88 that marks 38.2% retracement. And again, we have ascending 55 days exponential moving average. This is seen as ideal reversal point in case of further dips, to keep the immediate bullish structure in play for repeated attempt at 163.00. Otherwise, a further dip down towards 161.50 and the 161 zone could be as a likely scenario, while a break below a previous high at 161.30 would attract 161 and confirm the double top at near-term double top at 163 zone. On the 4-hour chart, the indicators are now emerging out of the overbought territory, and all pointing lower. That sees potential for some stronger corrective action, while strong daily bullish structure remains intact for now, although the stochastic is reversing at this point, and this could be also signal for some stronger corrective action, as we had also 2 days ago the Gravestone Doji candle on the British pound against the US dollar. Dollar yen is at the back foot, still following failure to surpass 84.50 as our initial barrier en route towards 85.00, our next upside target, with the 4-hour chart bulls now giving way and the bears coming in play as the pair dips as low as 83.80. This is our initial support, and so far holds the downside approximately, again 23.6% retracement of the uplift from 81.71 to 84.61, with the another significant supports at 83.60. This is the low of 17th of December, and 83.30. Low of 14th of December 2012, below which the risk they would shift completely towards the downside, and look for test of a very strong support at 83.00 and 82.80 previous tops, below which we will have confirmation of a stronger reversal of the recent strong rally in past 3 months from 77.12 that peaked at 84.61 so far. The daily structure is also the daily studies are also overbought and reversing RSI now emerging out of the overbought territory could signal some more significant corrective action along with the reversing stochastic. Still needs confirmation that will be seen on the downside break below 83.60 and 83.30. This is also lending a negative support to the pair for a possible stronger corrective action, as yesterday's fundamentals gave good boost for the greenback and post the recent rally against Japanese yen. And finally, dollar Swiss that is in the corrective mode, but again, like the other instruments, the corrective action is limited. 91.51. This is the previous low of 17th of December. So far, the gains were capped at this point, and the bearish tone is now fading, I would say, at this point, according to the 4-hour ADX chart, while daily bears are still in play, although sort of easing in the current bearish structure could be seen. Of course, we need to see a gain of minimum 92.00 as our initial barrier, 55 days exponential moving average, and the 38.2% retracement of the downleg from 93.81 to 90.81, yesterday's fresh low seen on a break below psychological 91.00. And then more significant is 92.40 zone. This is the previous congestion floor, and it's approximately 50% retracement of the entire move. A break of these levels would be a good signal for some stronger corrective action. Otherwise, resumption of the broader bears, as shown on the daily chart, that bears are fully in control, would signal a further extension lower and test of our downside targets at 90.40 and then 90.00. As we said, on the upside, we should watch levels at 91.50 that is still capping the upside, and 92.00 as the initial and the next barrier. Conversely, a loss of 91.00 and then 90.81 will open immediately 90.40 and then 90.00 the downside targets. As we said, the pair remains in the strong downtrend, and the current move higher could be seen as a brief correction preceding a fresh weakness. And the top loser yesterday was yellow metal, as it fell sharply again on the news from United States, losing ground and losing previous lows and supports at 1660. That also marks 200 days moving average. We mentioned yesterday in our analysis that consolidation above 1660 could travel up to approximately 1684, with 1676 being the highest level seen, as the 20 days exponential moving average maintained the negative tone, and fresh slide on the negative news pushed the yellow metal down to 1635. So far, we have set the target at 1630. That is Fibonacci expansion, 100% of the wave from 1752, and this is also equivalent of the initial wave from 1795 to 1672. That has been projected at 1630. We have nearly reached our downside target. Some corrective action now could be seen based on oversold conditions on 1 and the 4-hour charts, with not much prospect seen towards the upside, as larger picture bears are still firmly in play. Good resistance, I would say, is the previous low and the 200 days moving average at 1660, and it's also reinforced by descending 55 days exponential moving average. If we see it again above this level, and probably weekly close above this level, then some stronger corrective action cannot be ruled out. Otherwise, fresh extension lower and the break below 1630 would open way towards psychological 1600 level, and the lows at 1590. This is the low of 15th of August 2012, and basically this could be seen as the next downside target, as a bearish assumption is seen quite likely at this point. as the negative tone continues to dominate on the larger and the lower time frames for the yellow metal. And finally, crude oil, we said that it regained the important levels, 90.52 seen so far. Basically, we cleared the 90.31 previous peak, and the 90.42 that marks 38.2% retracement of the larger down move from 100.72 to 84.05, with the 90 days moving average currently 90.57, so far capping the recovery. Further bullish resumption higher after the current correction that is so far been has so far been contained at approximately 89.00, would target our next upside levels. We have the Fibonacci expansion at 91.46. Of course, first we have the 91.00 as round figure resistance, and the 91.30 is the channel resistance, and then we have Fibonacci expansion at 91.46. Ahead of this, on the larger extension, broader extension higher, we have 92.12, which is 200 days moving average, and the 92.38, 50% retracement of 172 to 84.05. Back to the lower time frames, the hourly structure is still negative, but reversing. Stochastic sees potential of basing attempt at 88.92. This is the fresh low seen overnight, and basically reversal at these levels could be seen as ideal for a fresh bullish resumption. I would say further extension lower is not ruled out at this point. 88.50 and 88.00 could be seen as a good supports, and any break below these levels would delay immediate bulls and bring the pair back into the recently established range of 84.05 and approximately 90.30.40 levels. On the upside, as we said, the break above 90.52 opens 91 and then 91.46 Fibonacci expansion level. This is all from me. Please, if you have any questions, I'll be glad to answer. If we don't have questions, or if you are still typing them, I would like to bring to your attention, as Christmas holidays are coming, I think you all received the holiday schedule. Our office is going to be closed on Tuesday, Christmas Day, with some early closing seen on on Monday, 24th of December, and some late opening on certain instruments seen on Wednesday, the Boxing Day. Our daily market reports will not be released until next Friday on both English and Arabic. So our next session will be next Friday. That is, if I'm not mistaken, 28th of December 2012, and then I think we'll have another one on Monday, 31st of December. If I'm not mistaken, you will receive I think you have already received or you will receive it today from our marketing services that are in charge of arranging these things. You will receive an email with the schedule for the Christmas and the New Year working hours. Since we don't have a question, I would like to thank you all for being with us and wish you a very nice and relaxing weekend, and of course very happy and relaxing Christmas holidays, and we'll be back next week with the fresh news and the movements in the markets that we believe there will be something. It's end of the year, although due to the holidays we might see some lower volumes, but still a lot of action seen from United States as fiscal cliff is still hanging above the current market situation, and the failure to reach any agreement could have, of course, a stronger impact on the markets in both ways, but especially in case of failing to find agreement, then that would be quite a disastrous scenario, as this will pull the United States back into recession. Again, thank you very much, and we will talk in our next session. I think it's next Friday. I wish you a nice day and very profitable and successful trading. Good luck.